Hello, Business 330 class. This is Professor Hassey. It's our week number 6 course lecture video for Business 330. Our topic this week in week 6, capital budget analysis. I'll first of all this week review a couple of the key areas that we missed in assignment number 2, which will prove helpful in future assignments in our course. We'll look at a capital budgeting case, began last week, and we're going to complete it this week with the perfect examples of chapter 8, 9, 10, and 11, a capital budget case problem. Then we'll review our Road Kings Trucks case, which is now posted to the Road King Trucks case file folder in Blackboard. This is a capital budget case where you are to prepare a capital budget analysis and then write a paper answering 6 questions that are in that case. It is due August 8th, Sunday. So you have a few weeks to prepare for it. And after this week, you should be able to begin that work. We will practice work on this case in assignment number 3 next week. But first, let's look at assignment number 2. Assignment number 2 was to go over the concept of time value of money, bonds, and stocks from our earlier chapters. And a couple of, everybody did pretty good on this, but a couple of areas where we had some trouble, and you need to clean these up for future work involving our class. The first one was question number 1. What is the future value of $10,000 if it's deposited for 5 years at 6% simple interest? Well, in the past, we looked at a future value where the interest is compounded. In other words, taking 6% in year 1, compounding, adding the interest, compounding that, and so on. If you did that, the answer is $13,382.26, which many of you had. But because it's simple interest, all we do is take the $10,000 times 6% times 5 years, and you get $3,000 of additional interest, or $13,000. So the key thing in this question was understanding the difference between simple interest and compounding interest. So the answer is C for that one. In question number 2, what is the present value of your trust fund if it promises to pay you $50,000 on your 30th birthday, 7 years from today, which earns a 10% compounded annually? In other words, what's the present value of $50,000 discounted at 10% for 7 years? Well, let me show you that in a spreadsheet. So if I go to my spreadsheet and go to Formulas, Function, Financial, Present Value, PV, I can calculate that present value of $50,000 by putting in the interest rate, which is 10%. That's the discount rate. The number of periods is 7. It's over 7 years. And the future value, what we want to have in 7 years, is minus $50,000. If I hit OK, I get $25,657.91. And that's the correct answer. In other words, it's taking the future value of $50,000, and discounting it back in time at 10% over 7 years, and the correct answer is $25,657.91. In question number 3, we are asked to determine the value of cash flows, with $1,000 being received today, $2,000 at the end of year 1, $4,000 at the end of year 3, and $6,000 at the end of year 5. What is the present value of these cash flows with an interest rate of 7%? Well, let me set up our spreadsheet to do this problem. Okay, in question number 1, part 3, it's asking you to determine the present value of cash flows being received in the future. Today, right now, we call that year 0, it's $1,000. At the end of year 1, we get $2,000, nothing in year 2, $4,000 in year 3, nothing in year 4, and $6,000 in year 5. So what we need to do is determine the present value at 7% or discount those amounts for those periods of time. So 1,000 today is worth 1,000. So there's no discounting there. If we take the formula present value at 7% for one period at $2,000, 1869.16, $0 in year 2. If we take $4,000 present value discounted at 7% for 3 periods, 3265.19. Year 4, nothing. And then in year 5, $6,000 discounted for 5 periods at 7%, 4277.92. Add all those up, we get the answer, which is letter B, 10,412.27. We can't forget that the year 0 has a $1,000 value because it's not discounted. It's happening today. So the cash flows going out into the future that total $13,000. If you discount those cash flows per their particular numbers of periods of time, you get a current value or present value of $10,412.27. And finally, in the assignment number 2, question 2, bonds. What happens to the price of a 3-year bond with a par value of $1,000? That's its value, at maturity, with an 8% coupon when interest rate changed from 8 to 6%. The answer is the value of the bond goes up because interest rates now are below the coupon rates. Interest rates drop, values go up. $1,053.46. Well, here's how you can calculate that amount. So I bring up my spreadsheet. Here it is right here. So I go to the formula function present value. I'm going to determine the current present value of this bond, an 8% bond in a 6% market, present value. So the interest rate in the market now is 6%. The interest rates have changed from 8 to 6%. So the interest rate is 6%. The number of periods is 3 years. The payment, in other words, what's the coupon on this bond? Well, it's a $1,000 8% bond. So the payment or coupon of whoever holds this bond is getting $80, 8% of $1,000. And the future value or the par value at maturity is $1,000. Notice I put in the negative sign here to make sure the number ends up positive. So we're going to determine an 8% bond, $80 payment due in 3 years with a future value of $1,000 in a market of 6%, $1,053.46. So the interest has gone below the coupon, thus the value of the bond in the marketplace has increased because you're getting 8% money in a 6% market. That is called a bond at a premium. It's worth more than its par value because of the interest rate situation. And that's one of the key rules of bonds and credit is that if interest rates drop, existing credit, existing assets become more valuable. If interest rates go up, it goes the opposite way. So that's a key part of interest in bonds. And one of the major discussions now in today's economy is everybody's all scared of interest rates. Inflation is when inflation occurs and interest rates go up, existing assets reduce in value. And that's kind of like, that's the calculation for this type of problem. Okay, so that's the key main parts. Everybody else did very good on determining explaining an example of present or future value in your world. Everybody did a very good job explaining why one stock in your portfolio has been changed in either prices up or down so far this term. So everybody did very good, but those were a couple areas, especially in determining present and future value, discount rates that we're going to use and see in just a few minutes when we look at capital budgeting analysis. So those solutions are now posted to Blackboard. Make sure you look at your grade center and see your average in the course up at this point of time. If there's any holes, any zeros for work not posted, be sure to let me know what the status of that work is so we can get that cleaned up here in week 6 of business finance. Okay, now let's take a look at capital budgeting. Okay, now we begin our capital budget analysis. And if you remember last week in week 5, we were introduced to this concept of return on investment, net present value, internal rate of return, and discounted cash flow, and how to determine the cash flow. We looked at some problems. And now in week 6, we're going to look at the actual capital budget analysis all put together into one big project, one big spreadsheet to determine return on investment for a given investment. And why is this so important? Is because of any finance operation or financial management operation, the capital budget analysis is perhaps one of the most important because it tells you not only the return on investment based on estimations of budget, but it also gives you a strategic determination and a management guide into the future of how you expect an investment to pay off over time. And that is huge in business. This analysis is done for any purchase of assets, major capital assets in every corporation in the world. It's done by everybody. So this is a key analysis that every business student needs to understand. And so that's why if you look at our Blackboard site, and you go now and you'll see in the left-hand column, oops, hang on just a sec. Okay, so if you go to your Blackboard file folder, you now see on the left-hand side a Rogue Kings assessment case paper. Click on that, and you'll see the files necessary for you to complete this case analysis. And let me explain this process to you a little bit. Every course in the business administration program has what is called an assessment value. In other words, certain things that the course has to teach the students. And we need to do this in order for these business programs to be accredited. And that's why you come to school here, because you want to go to an accredited institution with an accredited program so you know you're getting value for your money. And part of this Business 330 course, the assessment case is the Road Kings paper, because the accreditation committee determines that this case properly shows what is needed as what a student needs to take out of a finance course. It's a combination of time value of money, determination of financial information, financial statements, financial spreadsheets, and interpretation and a paper. And that's what this case is. So I've given you 4 files. Each file is in a PDF and a Word doc format. And what you need to do this next week, leading up to our class next week in week 7, is I just want you to download these files and read them. It's an introduction to the case, okay? We're going to practice a similar problem to this in our assignment number 3 next week. But all I need you to do now is download them and see what they offer, see what they have, what you have to do. I also give you a rubric, an introduction to the case, and a case deliverable file, which explains the case and what you need to do and the format that you have to do it in. So please download these this week, and we'll review them in our week 7 class and begin the work on it next week. One thing to know, I will have review sessions. I will have a lot of extra tutorial time on this case. So please download the files and we'll begin working on them next week. In week 6 this week of our Blackboard, I have a file right here, week 6 capital budget analysis. This is part of my introduction video earlier this week. We're now going to create and work on this file. So here we go. Okay, so here's that file folder. And we began to look at this last week. It's the capital budgeting process. In this class, we're concentrating on the first 5 steps. The 6th step, we're not. We looked at this in our introduction video. And in this file folder is the problems we reviewed last week from chapter 8, which determines the 4 investment return calculations. We looked at chapter 9, putting together the cash flow statement. Here's our tab for the solutions that we just did in assignment 2. And here's the capital budget process. And here's what is called a base case. This is a $1 million investment with a depreciable life of 10 years with all the inputs of what this company estimates will be the costs and the revenue off this investment. And we are to put this into what is called a capital budget analysis and then perform the 4 return calculations for dollars, NPV, percent, internal rate of return, ratio, profitability index, and years in payback. And that's a typical capital budget analysis. Here are the pages I reference in the text if you'd like to review this. But this should be your template going forward for the Road Kings case, for assignment 3. This will help you prepare that analysis. And then once we get this analysis done next week, we will review what does it tell us? What does this information mean after we provide the data? So I'm going to walk through this problem right now. This case is, as I said, a $1 million investment with a depreciable life of 10 years. In other words, that's what the depreciation schedule will be according to the IRS guidelines and what our accountants or public accountants tell us for this type of class of asset. So there's my investment in year 0 today, $1 million. It's going to generate 25,000 units a year in sales at a selling price of $20 a unit every year. And then after year 1, it's going to be inflated at 2.5%. In other words, we're going to increase the selling price of this product 2.5% every year after year 1 to take into account inflation. So if I go to my spreadsheet, I'm just going to put in here equals in year 1 for sales equals the sell 25,000 units times the selling price, $20. And I get $500,000. And look what that automatically happened. Because I have this template already set up, which could be to your advantage down the road, I included the inflation after year 1. I took the prior year revenue and increased it by the inflation rate 2.5%. In other words, times 1.025. So now I've accounted for and estimated $5.6 million in planned revenue off this $1 million investment. But look what also happened at the same time. Down here is called working capital, net operating working capital, NOWC. Notice here this input, 12% is our working capital percentage. In other words, in addition to spending $1 million in year 0 and throughout the project, we have to provide working capital to keep the asset going until the conclusion of its financial life in year 10. And that working capital is based on 12% of the next year's sales. This is calculated by probably your internal auditors, your CPAs, your purchasing agents. They do this within companies to determine the working capital rate. It's additional cash you need. Now, let me explain that a different way. If you go out and buy a car, you take out a car loan and you buy the car and you drive it home. All right. Now you owe the money on the car and you have the asset. But is that the end of your spending money on that car? No. You have to get insurance, registration, maintenance, all kinds of things involved in buying that car. Well, in order to operate the car, that's called working capital. It's additional cash you have to spend to keep the car running. Now, in business, it's exactly the same thing. But the good thing in business, not like your home automobile, in business, you get reimbursed for some of those costs as you sell the product over time through expenses, variable and fixed. But still, you need that upfront money to get the asset going before you start getting reimbursed for that cash flow. And that's what working capital is. It's 12% of the next year's sales. So look at in year two, our sales are $512,500. Well, 12% of that is $61,500. So what I did is I took the delta between year two and year one sales, which is $12,500. See it in this expression. And I multiplied that by negative 0.12. So in other words, I'm keeping the working capital base 12% of the next year's sales throughout the life of the project until I get to year 10. Then what I'm going to do is I'm going to add all that back as positive cash flow. In this case, it's 12% of year 10, 74,932. And notice it's not negative, it's positive. Why? The project's financial life is over. And now I assume I've been reimbursed for all that cash in the actual revenue and sales of that product. So the net effect of this whole line throughout the project now is zero. It's a wash. But I'm showing the proper allocation of the cash and it coming back in during the particular years of the project. That's working capital. Expenses. It says here that our variable cost per unit is $8 per unit. Now, what does that mean? It means our variable costs, if you remember this from accounting days, variable costs are wages, materials, costs per unit to produce your product. So in this case, it's $8 per unit. So we're producing 25,000 units. So here I put in equals 25,000 units produced times the rate of variable cost, $8 a unit, $200,000. And then note, I increase that by 2%, which is the inflation rate for variable costs. So each of this subsequent years increase by 2%. Fixed cost, which are again operating costs of the product, making the product, but they're fixed. They never change. They do not change in relationship to units. You're going to have those. So the fixed cost rate is $50,000, but also fixed costs do increase. And in this case, 1% a year, the fixed costs increase. So there's my fixed costs. Then I have one last expense, depreciation. And they tell us in this problem, it's being depreciated at $100,000 a year. So in other words, we're going to fully depreciate the asset over the 10 years to $1 million. So we're adding, that's an additional expense of the operations. Variable costs, fixed costs, depreciation of our operating expenses. And now we can determine our earnings before taxes right here. And the nice thing about this, I've set up this spreadsheet to do all this for you. One last thing. Notice it says here, the salvage value at the end of year 10 is $50,000. In other words, they're estimating at the end of the financial life of this investment, $1 million, it's going to have a scrap value or a disposal value of $50,000. All right. So that $50,000 is going to be cash received in year 10. But remember, we have fully depreciated the $1 million over time. So that asset on our balance sheet has a zero book value. Now, all of a sudden, we're getting $50,000 as additional cash for disposing it. That means that's a gain. So we have to pay tax on that $50,000 disposal gain of that asset. So we have to pay tax on that. So we'll take that $50,000 and we'll multiply it times 1 minus the tax rate. And the tax rate here is 30%. And we get $35,000. In other words, we're getting $50,000 additional gain out of this investment at the end of its life because it's been fully depreciated. So we have to pay tax on that. Our tax rate is 30%. That means we get to keep 70% of $50,000. So that's an additional cash coming in year 10 on the disposal at the end of its financial life of $35,000. This is, then we take the 30% tax out of our operating profits, and we get our net accounting income, $1.3 million. That's our accounting income. That's nice, but it's not our net cash flow, and that's what we're concerned about. This bottom line here, net cash flow. So our net cash flow is taking the net income and adding back the depreciation. Why? Because depreciation is a non-cash expense. We're allowed to depreciate and include it as an operating expense, but we're not spending any money. So then we're going to add it back in as cash flow because it was a non-cash expense. Add that back in. Here's that working capital we discussed earlier. Here's the salvage value in year 10. Here's the adding back of the working capital at the end of the life. And here, $2.417 million of operating cash flow off the investment of $1,060,000. On paper, that looks pretty good. We're making over $1 million, almost $1 million, yeah, much more than $1 million off this investment. But now we have to take into account the cost of money. And that's the WACC calculation, which we're going to talk more about next week. The WACC calculation determines what does it cost us to get the money. And in this case, and we'll talk about this next week, this case, and we also talked about it earlier in last week, it's due to our capital structure of 60% debt, 40% equity, our tax rate of 30%, our interest rate on that debt, the risk-free interest rate in the market return, the beta or the credit of the company, put all those together, 8.83% is our cost of capital. You'll have to be doing this calculation in assignment 3 and the Road King case. We'll talk more about this next week, but also we talked about it in week 5. So we go back to our base analysis, and now we're going to discount, just like we did in that question number 3, question number 1, part 3 in the assignment. We're going to take this future cash flow and discount it back at this 8.83%. Formulas, function, financial. The calculation is NPV, net present value. The interest rate is our discount rate of 8.83%. The values are years 1 through year 10, F21 to O21. That's our values. What's that $2.417 million discounted back at 8.83%? $1,510,832. Now we compare that to the net present value, and we get our into our cash flow on year 0. We compare that discounted cash flow, and we get our net present value. $450,832. Not bad. In today's value, today's dollars, when we're spending $1,060,000 to get this project going, we're making $450,832. The internal rate of return calculation, formula, function, we did this last week, financial, internal rate of return, there it is, IRR. And all we do here is put in the values from year 0. We include the investment year to year 10. And that comes up with a percentage, 17.03%. That's our return in a percentage. Our profitability index is the ratio of DCF to the investment, the relationship of discounted cash flow divided by, and I'll put that as negative, so to convert this negative cash flow to positive. So our ratio is 1.43. Anything over 1 is good. In other words, we're recouping our investment cost. Our ratio is 1.43. The payback in years, well, after year 1, we have an investment of $1,060,000. In year 1, we're earning back $2,035. There's our remaining balance at the end of year 1. In year 2, that's what we have remaining to be paid back. We add in year 2 return, That's what we have left. And let's just follow this all the way to year 5. And notice in year 5, we begin to get positive cash flow payback from this investment. 1, 2, 3, 4. And what percentage is what's left to be paid back to the year 5 cash flow? Equals negative 211,987 divided by the year 5 cash flow. Put that into a decimal, not a dollar. 1,234.94 years to pay back. In other words, we are paying it back a little bit less than 5 years. 4.94 of year 5 is paying, and then we pay back the $1,060,000. No discounted numbers here. It's just strictly a payback. So now we've completed our capital budget analysis. You're going to do this exact same thing in assignment 3. You're going to do this exact same thing in the Road Kings case and then interpret it and answer some questions in a paper format, this analysis. You're going to be doing it twice in Road Kings for 2 different products. The biggest hassle of this analysis is not so much the calculations. I'm giving you the template and you'll figure that out. It's making sure you get the right inputs, the right variables. That's the key to the Road Kings case, is because you have to decipher the information given to you in that case. You'll see that when you download those files, and make sure you find all those values and then some. So that's a capital budget analysis, and we'll talk more about this in week 7, and you'll practice it next week with assignment number 3. Download the Road King case, review this. I'm going to post this back to Blackboard so you have it. In this one file, week 6 capital budget analysis, you have last week's chapter 8 problem, last week's chapter 9 problem, some key parts of the solutions of assignment 2, the capital budget analysis process, the actual budget analysis, and how we came up with the working capital. This is a good file to study. So that's our week number 6 class lecture, dealing solely with that one file, that spreadsheet file that I've provided for you in the Blackboard folder. Download that, look it over, study it. You'll be in good shape. And we'll continue this process on into next week. You have no other graded work this week. Just download that case study. And also, as I mentioned earlier, make sure all of you check your grade situation in Grade Center. There's some of our students that have some holes, some no grades in some of their assignments or work. Make sure you clean those up or get in touch with me to make sure you can get credit for that work, because I have nothing for you now. So please make sure you clean that up, because next week we have the capital budget case that's due August 8th. We then have assignment number 3 next week, which will be a capital budget analysis. And then we have our final examination. So those are the 3 main grades left: assignment 3, the Road Kings case, and the final examination. So make sure you know where you stand in the class grade-wise as we head into these final half of our course. Thanks, everybody. Look forward to seeing you again this coming weekend with our introduction video. Have a great week. I'm available for any questions or concerns via email, text, or Zoom. Have a great week, everybody. Adios.